Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, welcome to the Equity Mates community. We have a massive episode for you today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. As you said, another massive episode. Always a massive episode. I'm always excited for them. We're going to cover off the news. We've got a question on hedged v unhedged ETFs. And we're going to close out the episode with sharing some experiments we've been doing with AI and how they can help us become better investors.
Huge episode, Ren, but the biggest news of the week, the RBA have cut rates, but it has been so well covered. So why don't we have a challenge? We're not going to talk about RBA or interest rates for the rest of the episode.
All right, challenge accepted. I think we can do that. But let's get into the non-central bank news that is moving markets.
News and markets.
China stocks have been star performers this year, but Ren, there is one huge reason that investors need to be wary.
Ominous, isn't it?
Dun.
So I think, the news is that China has had an incredible start to the year after a couple of years of being a real laggard. The mainland Chinese index, the CSI 300, has actually been So. It's up like 3%. It's chock full of like domestic Chinese industrial companies and the like. But the sexy Chinese companies move over to Hong Kong and list in Hong Kong. The Hang Seng index, the Hong Kong index, is up 15% year to date. Best performer of the world. Closely followed, would you believe it, by Germany, up 14%. Yeah. Europe and the UK both doing pretty well this year.
Yeah, good to see.
Yeah, all the laggards are coming to the party in 2025.
Except Australia. Up 4%.
Australia's been pretty good for the last few years, though. But look, what we really want to focus on is not just the Hang Seng as a whole, but particularly the Chinese internet stocks, because that's where the story gets really interesting. The Crane Shares CSI China Internet ETF is a way that you can sort of track some of these more pure play Chinese tech names. It's up 24% year to date and up 42% in the past 12 months. But if you peel that onion one more layer, some of the biggest Chinese tech names have done really well. Alibaba up 70% in the past 12 months, and Tencent, the maker of the super app WeChat, up 73% in the past 12 months.
Those acute listeners may also remember that the Crane Shares China Internet ETF was part of Andrew Brown's bold predictions. He's obviously expecting a bit of a rebound. Similarly, in our last episode, we spoke about Michael Burry loading up on Chinese stocks.
Yes.
It's all coming to fruition.
So
why be wary?
Yeah, there's a lot of reasons to be positive about China, but we came across a news story that just really exemplified why investors should always be wary of China. So they talk about the BAT stocks, B-A-T, in China, Baidu, Alibaba, Tencent, the big three tech stocks. We said Alibaba and Tencent are both up more than 70% in the past 12 months. Baidu, the often called the Google of China, not so much. And here's why. They are having a falling out with the dear leader, Xi Jinping, or at least they didn't get invited to the party. The news broke this week that almost $4 billion was wiped off Baidu's market value. And over the past 12 months, it's actually down because Robin Li, the founder of Baidu, wasn't invited to Xi Jinping's business symposium.
Wow.
Yes, he didn't get an invite and the stock has been punished as a result.
Wow.
Because that's the problem with Chinese stocks. It is so dependent on favor with regulators and with leaders. So Xi did meet with Alibaba founder Jack Ma, and we want to put a pin in that because that is interesting in and of itself. Also, Huawei's Ren Zhengfei and other top entrepreneurs in Beijing's strongest show of support yet for the tech sector. If people have been watching China for a little while, they may remember China's big tech crackdown in 2020.
Huge,
where they said that the big tech stocks weren't, acting in the national interest enough. They also cracked down on kids' use of technology
Yeah.
and video games,
Right,
limiting
yeah.
their hours, and a lot of the Chinese tech stocks have really been languishing since then.
So the irony there, Ren, is that Jack Ma, founder of Alibaba, went missing in 2021.
Yes, went missing.
Missing, yeah. The reason was he criticized regulators around the time of the Ant Financial IPO, and the Ant Financial was a spin-off, I guess, financial services company from Alibaba. And that shocked markets. Literally just disappeared off the face of the earth.
Yeah, for months.
For
wasn't
months.
it?
Yeah.
Then he rocked up in Japan.
Yeah, and then there was like a proof of life. Everyone was calling for proof of life.
Yeah.
And so he's like, no, I'm all good. But everyone was like, the video is so suspect. Like, where is he?
It was pretty grim.
Anyway, now he's back.
So
Back in the mix.
the Ant Financial IPO got nixed. And Alibaba's share price was down like 80% from there.
Yeah.
And, it was obviously caught up in bigger tech sell-off and stuff like that. But like everyone was like, okay, you can't criticize Chinese financial regulators, but like this is the sovereign risk of investing in China. And it seems like Baidu is now the latest example of that, where it is just so much of your business fortune is tied to patronage. That's why Alibaba and Tencent can be up so much. And Baidu doesn't get invited to the party. And so I think that's something that everyone getting excited again about the China internet story, and there's a lot to be excited about, just needs to be wary of.
Yeah. Well, Ren, speaking of excitement, we should nod to to SHEIN. Incredible growth story over the last couple of years. A giant now in e-commerce, like clothing, effectively.
Yeah, well, giant depending on whose valuation you take.
True. Well, speaking of, so they have been slated to be the biggest IPO of 2025. They were planning to do it in the US, but after regulatory scrutiny, they've moved across to the UK. Great news for the UK and the London Stock Exchange.
Yeah. It was going to be big for them. They are seen as quite a boring stock exchange, I guess.
Yeah.
But SHEIN has raised at $100 billion valuation. Like that's kind of ballpark where it sort of sits. But according to Bloomberg, there's massive pressure on them to cut their valuation from 100 billion down to 30 billion. Meaning the investors that put money in at 100 billion are being asked to take a 70% haircut on their investment. Why? Again, this ties in with questions around the risk of investing in China. Investors are worried about supply chain and about labor practices and how that affects the company's reputation and ultimately their valuation. Yeah. So I think, once again, there's probably a lot of Western investors that have got really caught up in the China story, got really excited by it, and are now potentially taking a big haircut. So that's not to say that we're not excited about the China story, and we wouldn't. I would be open to investing in China, but you've got to be careful because it's not. You're not just analyzing business fundamentals.
No way.
Yeah.
Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, friend. I've got a question. Your
Answered.
When the Aussie dollar is getting absolutely hammered, is it better to go hedged or unhedged with your ETFs? This is a question that we have had come through from David.
Well, you kind of asked the question.
Well, thanks for the question, David.
So, Bryce, you've given us the gist, but this David specifically wanted to know, is there any benefit in buying IHVV or IVV based on the value of the Aussie dollar? Now, IVV is the iShares S&P 500 ETF,
Yep.
and IHVV or HVV is the currency hedged version of it. So David went on to say, with the Aussie dollar being below its historical average of around 73 US cents, he assumes there is a benefit in buying IHVV. So he wants to know, is there extra benefit because you buy IVV with a higher Aussie dollar or IHVV with a lower Aussie dollar, or does it not really matter? So Bryce, hedged v unhedged, where do we start?
So Ren, let's start with the purpose of each. IVV, as we said, tracks the S&P 500 and it is not currency hedged. IHVV also tracks the S&P 500. It is currency hedged. When you're buying both of them, you're buying them in Aussie dollars. However, the difference is with IVV, you are exposed to the underlying currency fluctuations because it's unhedged. So when you effectively go and buy the index, if the Aussie dollar weakens, the value of your US exposure is going to increase and vice versa. With IHVV, all of that fluctuation is taken out and you're just getting the movement on the company itself.
Yeah. It's the same as buying individual stocks in the US.
Yeah.
Like as they're all priced in US dollars. So as the US dollar moves against the Aussie dollar, it moves the value of your Australian dollar holdings.
Yeah.
Yeah.
So if you buy IVV and the Aussie dollar continues to fall against the US, your overall exposure or value is going to increase, and vice versa. So I guess in terms of David's question, is there benefit in trying to play this? I mean, specifically you can when the AUD is weak. You could lean towards, well, I would suggest leaning towards the hedged because it's going to minimize risk. When AUD is strong, you probably want to look towards the unhedged version because you're getting more, I guess, bang for your buck when buying in the US dollar. My overall opinion though, Ren, is that's a pretty active approach to two products that are designed for long-term investing. And the way that I think about these, hedged or unhedged, is to ensure that you're finding a product where the strategy is right for you and that, you know, over the long term, I don't really take into consideration hedged v unhedged with these index products. If you want stability and you don't want to worry about it, then hedged is the way to go. If you're not really that concerned and you're just after the product, then IVV is obviously right for you.
Yeah, I think if you look at the performance over the last 10 years, the hedged version has done 12% a year over the past 10 years. The unhedged version has done 13%. And if you look in different time frames, if you look at like the 5-year, the unhedged version has done better. But then if you look in in every time frame, the unhedged version has done better. That also is related, I guess, to the effective fees. IVV has lower fees. But look, over the long term, unless you've got a really extreme starting point, you know, unless the Aussie dollar is buying 50 US cents or unless the Aussie dollar is buying a dollar, really net what is like the fluctuations will net out over time, and what's going to drive your investing returns is the underlying ETF.
Yeah.
So I think, I agree with you. It's probably too active to try and switch between the two. I think your trading costs and your tax costs and just the overall angst that it's going to cause you trying to guess the fluctuations of the currency is going to be too much. I don't buy hedged ETFs. If we got in really extreme situations, maybe I'd think about more short-term trades to take advantage of those currency discrepancies, but that would be different to my long-term core investing philosophy.
Yeah. Well, I hope that answered your question, David. If you would like to ask a question and get it on the show, there'll be a link in the show notes or description below where you can leave us a voicemail, or like David did, you can fill in the contact form and we'll try and get it on the show.
But we would prefer a voicemail.
We'd prefer a voicemail, yes. We found an AI tool that has 10x'd our ability to find stocks. Now, Ren, you've spent the weekend looking through Notebook LM.
Yeah, if people haven't heard of Notebook LM, it's a Google AI tool. And one thing that we've set out to do this year is not get left behind by AI. We want to make sure we're on the forefront. We're not on the forefront. We're not building anything. But as these tools come to market, we want to think about their applications. You know, we've got the Headlines by Equity Mates AI voiced podcast. That's us trying to figure that world out.
Yeah.
But there's heaps of tools that can make you a better researcher and more effective at consuming the fire hose of information that's getting sprayed at us every day. And this is a good one. So Notebook LM, what it allows you to do is upload sources. It can be audio, video, written stuff, and then the AI will consume that information and then you can query it. So I wanted to test it out. I got 20 Q4 investor letters. For people who are new to the show, expert investors will often write letters to their the people that have put money in their funds and say, here's how we're going, here's some stocks we like, here's what we've bought, what we've sold. And you can find a lot of them online. So I'd got 20 investor letters, call it, 200, 300 pages worth of material. Not something that I could sit down and read, but that's where, I could, but I'm not putting that time aside. That is the use case of AI. And I've got to say, Bryce, it's pretty amazing.
Yeah, I am constantly amazed every day at the stuff that I'm seeing come out of, come off the back of AI. So take us through what you've actually done here.
So I uploaded all 20, and I think one thing that we've learned with chatbots and also with this, ask general questions, get general answers.
Yeah.
So I asked it, synthesize all these letters and give me the 3 biggest takeaways. Now I won't read the whole answer, but the 3 dot points that sort of were the headings, value opportunities exist despite market concerns, active management and selectivity are crucial in an environment characterized by market concentration, and long-term perspective and cost consciousness are essential. Now, look, they're very general, and I didn't find that super helpful. The one cool thing that Notebook LM does is it will footnote what it's saying. So obviously we're worried about hallucinations with AI, but it will footnote where it's getting its takeaways from, and you can click it, and then it will take you to that part of the resource. So in my case, that part of the investor letter.
Great.
So if the first learning is general questions get general answers, you've got to be more specific.
Yes.
So how's this for a specific question? List the 5 companies most commonly mentioned in these letters. Please list the number of times they were mentioned.
Okay.
So Bryce, from these 20 investor letters, here were the 5 most common. Alphabet mentioned 8 times in 20 letters. Meta 7 times. Taiwan Semiconductor, TSMC, 6 times. Texas Pacific Land 5 times. Microsoft 5 times.
Interesting. What would have been a nice add to that prompt would have been list the 5 companies most commonly mentioned in there, list the number of times they were mentioned, and general vibe.
Well, I didn't want to overwhelm it because I feel like, again, it's like more specific and concentrated you are, you get a better answer. The more you open up the scope and be like, tell me this and tell me that, I feel like it starts to
wig out a bit.
Yeah. So I asked sentiment as a separate question.
Oh, nice.
So I said, review the 8 times Alphabet was mentioned. What is the overall sentiment of these mentions?
Interesting.
And it goes through the mentions and tells me what the letters said. To summarize it for you, a lot of them were basically saying that they owned Alphabet and it was a key performer for them.
Okay, so positive sentiment, but kind of rear view window.
Yeah, exactly. It wasn't a lot of like, we've
Going
initiated
forward.
a position in Alphabet. It was a lot of like, John Hempton's investor letter spoke about how it was one of their notable winners in a pretty tough quarter for them. Right Tail Capital, who we've interviewed on the show, they saw their holdings in Alphabet rise 36%. Wedgwood listed it as one of their top performers. So like nothing bad, but a lot of we've owned it for 15 years.
We love it. Yeah.
So if
Interesting.
we go back to those 5 companies that were most commonly mentioned, Alphabet, Meta, TSMC, Texas Pacific Land, and Microsoft. One of those not like the others?
Texas
Pacific Land.
Yeah.
So I wanted to hone in on that. And I asked it, what is Texas Pacific Land? And keep in mind, it can only use the source
I was
material
just going to ask
given
that.
it.
Okay,
So
so it won't pull in.
It can't go to like Wikipedia.
Yeah.
But there was plenty of information in these investor letters. Texas Pacific Land owns 800,000 surface acres of land in the Permian Basin.
Oil, is it?
Now, have you seen the Billy Bob Thornton show,
Landman?
Yeah. So
fascinating.
That's set in the Permian Basin.
Yeah.
So it acquired most of its land in 1888, and it has a heap of oil and gas royalties now as the Permian Basin is just taking off. I got a description of what Texas Pacific Land was.
Yeah.
But then I don't care about what it is. I care about should I buy it. So I just straight up asked, should I buy Texas Pacific Land?
Yeah.
And then it gave me arguments for and arguments against. Arguments for, one letter described it as an extraordinary, unique, and profitable business. It's got highly valuable assets, as we said, the 800,000 surface acres. Wedgwood expressed that valuation was high, but they are considering re-entering once it reaches a more reasonable valuation. So not sure that's an argument to buy it, but and then Greystone Capital Management spoke about it as a great business run by strong and capable management with long growth runways. Not bad.
Not bad.
But the points to consider, one was valuation, as we mentioned. Secondly, there were some questions around the royalty business model and whether there were better royalty players.
Nice. Okay, so at least there's a fair bit of stuff there for you to get a general sense and then probably go away. We'll definitely go away and do a bit more work.
Yeah, so I don't think this will ever give us the answer.
Yeah.
But in the same way, investor letters don't give us the answer.
No.
So what I'm really excited to do is when I'm like companies that I'm own that I want to keep monitoring, rather than reading all their stuff, just like
throw in the annual reports,
quarterly updates, just chuck it all in there.
Yeah.
Tell me what's changed over time. Like if you get 5 years worth of quarterly statements, that's 20 documents. Is management consistently saying the same thing?
Yeah.
Tell me how these numbers have changed. What numbers have they stopped reporting? What numbers have they started reporting?
Yeah.
You can start seeing how that grunt work becomes a lot less work.
Yeah, absolutely. I mean, transcripts, you name it.
Now, true. Yeah.
Earnings calls.
Now, to close it out, I did ask one last question, and I don't think we go through them all now, but maybe we'll include a link in the show notes or the YouTube description to share this information. But I had to ask the last question. Review all sources that I've provided. Pull out some interesting stock picks for me to go and research. Prioritize stocks I may not be familiar with, and for each stock, please explain in one sentence why it is an interesting investment opportunity. And good news, Bryce, it gave me 17 stocks. I would say at least 14 I hadn't heard of before.
I'm liking the name Get Busy. Listed UK listed microcap.
Yeah. So that's Notebook LM.
Nice. I love it.
It won't be the last AI tool we bring to the show as we try and keep on the forefront of what's emerging, but definitely one I'm going to use a lot more of. And I think there's some pretty interesting investing use cases, but also for equity mates, there'll be some interesting use
without
cases.
Without a doubt. It's life-changing. Now, it is life-changing.
Definitely.
Yeah.
You know who it's life-changing for? The investment analyst sitting in a back room, just like at a fund somewhere, just grinding
pumping
on.
through it. They still need to know what to ask.
Definitely.
You still need to be able to critically think about the information that it's spitting out. Like, what is the next best thing to ask here to get to what I want?
Well, or you just say all of a sudden, all these information sources that used to give people who were particularly diligent an edge, that edge gets arbitraged away as people, and more people get access to it in the same way that, Buffett's edge was reading company reports, and then that information got arbitraged away. And then it'll be something else, it'll be the next thing that we, going to the supermarket shelves and discounting or for retail stocks. Or you know what it is, like there's always the next level of research.
Yes, So if you want to have a look at all the 17 stock tips and a bit more detail,
17 stock research suggestions.
Stock tips. We're going with stock tips. You can download the PDF for free. There'll be a link in the show notes or in the description below. So click on that and you'll see exactly what we've been talking about with this LLM.
Well, that does it for this episode of Equity Mates. Make sure you're subscribed wherever you're watching or listening so you don't miss an episode. If you enjoyed it, would love it if you gave us a review on your platform of choice. It really does help us juice the algorithms. But more importantly, would love it if you could tell someone about it, because word of mouth is the biggest driver of podcast growth. Always has, always will be. AI cannot replicate what you can do to help us. So thanks for listening. But Bryce, that'll do us for this episode.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.